In this video, we discuss 9 reasons why many in the baby boomer generation may be in financial trouble. Coming up next on Holy Schmidt.
Holy Schmidt!
We're going to run through this very quickly because there's a lot to cover here, and frankly, it's all very, very important. But before we do, make sure you give the video a like. This helps the YouTube algorithm raise the video in the search results, and I want to help as many people as possible. All right, let's go. Number 1 is longevity risk. Let me start off with a little party trick that you can use that will amaze friends and strangers alike. Who first said, "I've got some good news and I've got some bad news"? No, it wasn't Alec Baldwin in the 1992 movie Glengarry Glen Ross, although that's frankly where I first heard it. The real answer is a gentleman by the name of Herman Kerner in his 1898 book Beleaguered. So let's lead with this. I've got some good news. And that is in 2024, as you approach retirement or even are in retirement, you're more than likely to live 20% longer than your 1960 self getting ready to go into retirement at that time. The bad news is that you now have to figure out how to pay for it, because people in 1960 didn't have to worry about extreme longevity risk, at least not to the extent that they do today. The biggest problem of all is that no one growing up actually knows what it's like to be older. And because of that, they don't plan properly. They think that they'll always be youthful until the end. This, by the way, is what Peter Attia calls his health span concept. Meaning that growing up, we all think that we're going to be able to do the things we can do today, even if we're not required to do them anymore, including work, for instance. But that actually isn't the case in late stage retirement. Next, baby boomers are sometimes now called the sandwich generation. This is the generation that cares for both their aging parents and their adult children financially. The same medical technology that has increased your lifespan, the one we talked about just a minute ago, has also done the same for many of your parents. This means that they're living longer and hopefully they have a long health span, but frankly many do not, and this is where things get costly. On the flip side, the requirements for success for our children has gone way up. I don't know about you, but when I was 19 years old, I moved out and never moved back in again. I went to night school and worked during the day to pay for my college. I then put myself through graduate school at the Kellogg Business School and moved here to New York with my wife and my 1-year-old child to start a career in banking. Today, there are more safety nets and children are taking longer. Probably not a bad thing, but it does impose a financial obligation on adults and retirees, frankly, that may not have existed 30 years ago. So on one end, your parents are living longer, and on the other, your children are on the payroll longer, so to speak. Next, Social Security is somewhat inadequate today, much more so than it ever has been in the past. Let me explain. Social Security is under pressure due to stagnant growth in the workforce. Historically, the number of workers per retiree was much larger than it is today, so the funding is getting depleted. The actuaries know this, and the SSA and the government has made small changes that have had a big impact over time. For example, moving the full retirement age from 65 to 67 has had a dramatic impact on the payout. Moving full retirement age from 65 to 67 without a corresponding move in the actions of the workforce has meant that people get paid less. And people, on average, take Social Security today at age 62. The majority of people do now. That's the first year that they're eligible. This means that people aren't working longer, by and large, to age 67. Additionally, if someone wanted to draw Social Security at age 62 and, say, invest it, the maximum they could earn without having to give part of it back would be $22,320 in 2024. For every dollar beyond that, they have to give back 50 cents. Once they reach full retirement age, they can earn as much as they want. Next, the taxability of Social Security went into effect in 1983, at which point up to 50% of your Social Security became taxable if you earned over a certain amount. That went to 85% in 1995. The problem is that those thresholds haven't changed, the ones that were put in place in 83 and 95 respectively, which means that you're far more likely to pay tax on your Social Security today than you would have been back in the day. Next, debt in retirement is more prevalent than it is today than it ever has been in the past. According to the 2022 Survey of Consumer Finances, which actually came out this year for the period ended 2022, 65% of retirees between 65 and 74 have debt in retirement. That amounts to, on average, $113,000 of mortgage debt and $45,000 of other debt, car, student loan, credit cards, for example. It gets a little bit better at age 75 plus. The number goes down to 50% of retirees at that point. For reference, 20% of the 75 plus crew had debt in 1989. So we've gone from 20% in 1989 to 50% in 2024. This is, of course, a byproduct of tougher times, easier credit standards, and just a general belief that debt is going to be part of one's life. Next, inadequate retirement savings. The average retiree has a median retirement savings amount of $200,000. Now that sounds like a bit of money, and it is, but using the 4% rule, the 4% withdrawal rule, $200,000 at 4% means that you can withdraw $8,000 per year. When combined with an average Social Security payment of $18,060, that means the average retiree is bringing in approximately $26,000 of spendable income per person. The Survey of Consumer Finances isn't far off, by the way. They ask the question directly, what is the family income? And that number for a retiree is $60,530 for a family. So there's probably some pension income in there, but frankly not much. What does this mean? Well, for some people it's fine. The amount is adequate enough. But when you overlay the debt that we talked about, then the picture starts to change. The debt service payment on $158,000 per person at 4% is approximately $8,000 per year per person. This means that if a couple was bringing in $60,530, if you subtract 8,000 times 2, 16,000, they're actually bringing in $44,530. Next, rising healthcare costs. All right, let's talk about the elephant in the room. The average retiree couple thinks that they're going to spend approximately $41,000 over their lifetime combined in medical-related costs. And this number is primarily, in their mind, the cost of Medicare and the associated Medicare, Medigap policies. But the actual number, according to Fidelity, is $318,000 for that couple. So why is there such a big gap? Well, first, people only think about Medicare and the costs related to Medicare, but they don't think about the health insurance payments that they have to make if they retire before age 65. They still have to pay for medical insurance, and that can be quite costly up until age 65. The second is a cost that almost no one thinks about, and that's the cost of long-term care. Most people don't think that they're going to need long-term care, but in fact, many do. And the cost per annum is $108,000 for long-term care per person. Next is the pension shortfall of a company itself. Before the advent of a 401k, the companies provided something called a defined benefit plan, meaning that the benefits that you would receive were defined at the beginning of your employment. You knew with a very strong degree of certainty what you were going to receive in retirement if you stuck with a company for 30 or 40 years. This type of plan engendered lifetime employment, dedication to the company, and skilled employees pass their skill down to other employees who came into the workforce later. Now the model is turned upside down. Today, people are thought of in terms of where they fit in the contribution to, in many cases, the revenue of the company. For example, if you're a revenue generator, like a salesperson, you fall into one category, particularly if you're a really good salesperson. If you are a cost center, like someone that does something outside of sales and marketing, for example, in many cases, you're actually considered a different type of employee. Cost centers are often outsourced. That isn't always true, of course, because there are some very skilled people who do what they do that aren't generating revenue, but it is a higher risk category. Conversely, if you're not good at generating revenue, you're at extreme risk of being put out of business very, very quickly, because in many instances, you're either a revenue generator or you're not. It's either in your DNA or it's not. Overlay the fact that union agreements have absolutely crushed the defined benefit plan, and you now have a situation where people are contributing to their 401k, and that is their primary source of retirement revenue. There are exceptions to this, of course. Government jobs do still have defined benefit plans, but most corporations no longer offer this feature. Next, market volatility. Most people retiring today have seen a wonderful run in the market over the last 40 years, but it hasn't always been that way. For example, when stagflation hit, the period between 1973 and 1982, prices continued to go up, but the market effectively stayed flat over that period of time. Let me explain. In 1972, the S&P 500 closed the year at 118. In 1981, the S&P 500 closed the year at 122, effectively flat for that 10-year period. For reference, the average cost of a McDonald's hamburger was 21 cents in 1972 and 45 cents in 1981. Is it possible in the years ahead we could face prolonged periods of high inflation and low market performance? Well, you tell me. In a future video, I'm going to talk to you about how to manage these issues if you're worried about them, so make sure you click subscribe and turn on notifications so that you get alerted when I post a video. I post approximately once or twice per week. Also, if you want to see a different side of me, check me out on Instagram. I'm at the handle _Schmidtlist. Also, if you like this video, check out that video on why the majority of people take Social Security at age 62. This is Jeff Schmidt. Thanks for watching.